everyone, you're on the Polyinvest channel, and today we'll figure out the essence of centralized and decentralized exchanges, as well as look at their pros and cons. Have a great view. In the world of cryptocurrencies, there is a concept of centralized and decentralized exchanges, but not every new user understands their difference. A centralized cryptocurrency exchange is a platform that's regulated by a central authority, acting as an intermediary between the buyer and the seller of cryptocurrency. An important feature is that centralized exchanges require undergoing KYC. This process is necessary for identity verification. In the future, it prevents various financial fraud and money laundering. Meanwhile, centralized exchanges also rely on order book technology. This simplifies the trading of cryptocurrency. Many centralized exchanges also resort to the help of market makers. This is necessary for ensuring the liquidity of the quoted cryptocurrencies and providing competitive resources. Examples of centralized exchanges: OKX, Bybit, KuCoin, and Binance. All these exchanges have good ratings and a user-friendly interface. You can register on these exchanges using the link in the description and check for yourself how convenient they are. Of course, a welcome bonus will be waiting for you there. The positive aspects of centralized exchanges can include their simplicity and ease of use. Moreover, established exchanges use a wider range of cryptocurrencies. Their extensive range of options makes it easy to diversify your portfolio. Another important distinction is good liquidity. This means that the user can easily sell or buy an asset without affecting its market value, which is, of course, a deciding factor for traders who want to quickly make a transaction with low volatility. The main reason why centralized exchanges have higher liquidity is because of their access to more extensive semi-buyers and sellers. Another important point is that most centralized crypto exchanges are owned by regulated organizations. It follows that they are subject to strict regulatory supervision. And of course, this attracts institutional investors who are required. A certain degree of compliance with regulatory principles, but in addition to good qualities, centralized exchanges also have disadvantages. For example, users cannot control the keys to their crypto wallet. This means that they do not have direct access to their assets. This can lead to financial losses in case of a sudden closure of an unregulated exchange. Another downside of centralized exchanges is the provision of services. They are designed for maximum profitability, and of course, this can lead to a conflict of interest between the buyer and the seller. Some unverified centralized exchanges might manipulate market data to boost their profits through unethical methods. It's recommended you only use verified and reliable exchanges like those I discussed earlier. Now that we've gone over centralized exchanges, let's transition to decentralized ones. What exactly is a decentralized exchange? These types of exchanges support peer-to-peer trading among cryptocurrency users. These processes are controlled by smart contracts, which are essentially self-executing applications based on blockchain technology. This approach eliminates intermediary involvement, and it's not necessary to pass QIC on these exchanges, allowing users to trade anonymously. Decentralized exchanges include ones like PancakeSwap and Uniswap. The absence of QIC allows these exchanges to serve unbanked users who can't access banking services, maybe due to lack of documentation. Decentralized exchanges provide direct transactions between buyer and seller, and they don't have middlemen, making the fees for such transactions lower than those on centralized exchanges. But despite all their appealing features, decentralized exchanges also have their shortcomings. For instance, they often have a lower liquidity due to a smaller user base and trading volume. This lack can result in significant price deviations of assets from prevailing market rates, leading to unfavorable trading outcomes for sellers. Another downside of DEXs is that they are more technical in nature and require knowledge of blockchain technology to use. For instance, users are required to utilize compatible wallets for trading and must manage their keys on the platform. Another technical consideration involves users needing to acquire the platform's own tokens to pay for gas. To get these native tokens, users often have to purchase certain cryptocurrencies that can then be utilized to buy native tokens on decentralized exchanges. These steps could be quite difficult for newcomers and could result in asset loss. And certainly, the lack of stringent checks like ID verification make these exchanges more susceptible to illicit activities, such as money laundering. Hence, regulated businesses that wish to invest in cryptocurrency steer clear of these exchanges. Another common drawback of DEX is the absence of customer support. This can raise serious issues for users who require help. Well, here we are examining the qualities of centralized and decentralized exchanges. I hope everything was clear to you, but the choice of which exchange to use is yours. Thanks for watching. Don't forget to subscribe.